The U.S. government is now as risky an investment as AI. August 22, 2026. A profound transformation is underway in global financial markets. For almost 4 decades from the early 1980s, nominal interest rates steadily declined, encouraging governments, companies and households to accumulate enormous amounts of debt. The 2008 financial crisis should have ended this trend, but policymakers, desperate to avoid a depression-style liquidation, pushed rates to zero and even below it while central banks flooded markets with liquidity. That era ended with the post-pandemic inflation surge. Interest rates have risen, and hopes of returning to permanently cheap money have repeatedly been disappointed. The backlash against globalization and growing geopolitical instability have reinforced inflationary pressures, producing a global bond market rout. One of the strangest consequences is the growing disconnect between bonds and equities. The yield gap between 10-year U.S. Treasuries and the S&P 500 has widened to almost 4 percentage points, a multi-decade extreme. At the same time, the equity risk premium, the extra return investors demand for owning stocks rather than supposedly risk-free government bonds, has fallen to its lowest level since the dot-com bubble and has almost disappeared. This suggests 2 troubling possibilities. Investors no longer regard government debt as genuinely risk-free, while equities appear dangerously expensive by historical standards. Inflation concerns are rising just as stock valuations have reached potentially unsustainable levels. Yet the divergence does not necessarily mean an imminent stock market crash or fiscal crisis. Higher bond yields can simply reflect expectations of persistently higher inflation. Equities may also be relatively better protected because companies can raise prices and preserve profits and dividends, whereas fixed income investments are directly eroded by inflation. Investors have not abandoned bonds altogether. Instead, they increasingly favor short-term securities, which offer returns close to cash without exposing them to the inflation risk of holding long-dated debt. Governments are consequently finding it harder and more expensive to borrow for long periods, pushing up mortgage and other borrowing costs. Another major competitor for capital has emerged: the giant technology companies building AI infrastructure. Hyperscalers and other AI leaders are consuming enormous amounts of capital, increasingly tapping both credit and equity markets. They are competing not only with other industries but with governments for scarce financing. The author remains skeptical that the enormous investment in computing power will ultimately generate sufficient returns. Like earlier technological booms, the AI revolution may leave society with valuable infrastructure while causing substantial losses for investors. So far, its promised disinflationary impact on the wider economy has also failed to materialize significantly. Nevertheless, AI companies are raising extraordinary sums. SpaceX has reportedly sought $50 billion through an IPO, Alphabet is raising most of a planned $90 billion in equity, and Oracle plans around $40 billion in debt and equity financing. Planned listings by OpenAI and Anthropic could further test the capacity of equity markets. The result is an extraordinary market paradox. U.S. government debt, despite huge fiscal deficits, is being priced as carrying roughly the same risk as speculative AI ventures whose future earnings remain uncertain. Bond investors are already paying for the excesses of the cheap money era. Holders of a UK gilt issued at just 0.5% and maturing in 2061 have lost roughly half their investment in market value. Although the principal may eventually be repaid, inflation could leave its real value dramatically diminished. The bond market reckoning has therefore already begun. The potentially much larger reckoning in equities, however, has yet to arrive. By The Telegraph, story by Jeremy Warner.